Dividend investors, bonjour. This is Mike Giroux, founder of Dividend Stocks Rocks and passionate investor. Today, I'll be talking about my favorite undervalued stocks. The ID came from Ryan, and I want to thank you, Ryan, because I know that you've been following me on Twitter since almost the very beginning. So kudos to you. Thank you for your support. And if you're not like Ryan, well, here's your chance to subscribe to the channel and get your question answered. So whenever you have one, go in the comment section, type it in, and I'll keep notes. So Ryan asked me, well, Mike, the market is crazy. Pretty much overvalued everywhere. Can you find any undervalued in this crazy market? So today we're talking about my top 5 Canadian stocks, and next week I'll go around for my favorite US undervalued stocks. But first, a word of advice here. A lot of people likes to use different kind of valuation models, and they love to find a bargain. They love to find an undervalued stock. However, I think that this is greatly exaggerated in the market. Look at this graph right now. Last year, April 2020, I had that discussion with Colin, a guy on Twitter that I respect, that I love. We have plenty of discussion about the stock market. It's always fun because the guy is incredibly knowledgeable, and he kind of like threw that wager at me on Twitter saying, hey, how about we bet a beer that my undervalued pick, which is ExxonMobil, will outperform your overvalued pick, which is Microsoft. So it's a 2 years period. We're not done yet. Actually, we're just halfway through the challenge, but it's kind of funny because the overvalued stock is currently outperforming ExxonMobil, which is greatly undervalued per definition. So then again, what was the point to get a bargain if when you overpay, technically you're making even more money? As you can see, the wager is not done. There's a lot of fluctuation. Maybe I'm going to end up being on the losing side next year, and I'll be fine with that, because my point here is nobody knows about anything about valuation. So just be careful with that. Full disclaimer, do not trade on this video. Do your own due diligence. I just want to point out a few stocks that per the current P ratio. So I'm looking at the price earnings over a long period of time to see what's going on. I'm comparing it to its peers as well. So other companies in the same sector and overall companies that I love and in the first place, because I think for me the most important part is to invest in companies that has a strong dividend triangle, which means growing revenues, growing earnings, and growing dividends. If you pick those companies, chances are over the long term you'll do just fine. So let's start with number 1, which is not necessarily number 1 in terms of my favorite one or the best opportunity, but because we're starting this video in alphabetical order. So the first one is Algonquin Power and Utility. Ticker is AQN, trades on both US and Canadian stocks. What you see there on the graph is the US numbers. Why? Because the company pays its dividend in USD. Very interesting here. You see earnings is growing quite steadily. Dividend is growing quite steadily, and we still have reached a plateau in terms of revenue, so we have to be a little bit more careful here, but overall the dividend triangle is relatively stable. I have covered Algonquin utilities completely in my top Canadian utilities video not too long ago. I'll put the link in the description below, but I just want to give you a few more words about it. First, when you look at the current PE ratio, we can see that it is on a downtrend in terms of PE. The PE forward is quite stable around 22, but overall we can see that there was a lot of hype around Algonquin Power a few years ago. Now it seems to be faded a little bit. I explained not too long ago while renewable utilities stocks are going sideways these days. So I think that overall in this sector, it creates a lot of great opportunities, and Algonquin is one of my favorite. It's one of my favorite because the company has a great business model where you have 65% of the business around around regulated utilities, and then 35% towards a little more growth in terms of non-regulated renewable energies. So you can benefit from both a stable ways of generating cash flow, which ensures to fund some projects, which ensures also to increase the dividend, and at the same time you can hope for more capital gain for the stock price because they are looking at renewable energy. This is trendy, this is what we need going forward, and this is exactly what they intend to do in the future. So the growth is all around renewable energies. They have an important capex, a lot of projects to be invested there, and what they do is, while it's not regulated, they tend to send PPA, which are purchase agreement, usually with governments or cities, and they have long-term contracts. So we're talking about a target around 15 years. So this helps a lot to fund the project with cheap debt right now, so they don't pay too much for their interest rate, and then they know for the next 10, 15, 20 years they'll get the contract. Usually they're escalated contracts, which means that they're protected from inflation, and they will be able to project how much cash flow they will receive from those projects. So for all those reasons, I think that Algonquin Energy is a great stock to buy, and I even did it myself a few weeks ago, back in March actually. Second one, it will not come as a surprise, but AlimentationCouche-Tard is definitely one of my favorite pick right now for the year. I've increased my position earlier. I've done a few videos about it, so links description below. What I love about this one is they were able to increase their earnings even during the pandemic, which shows that they are able to adapt. And even though gasoline sales were down, and this is why the revenue started to fade a little bit over the past 12 months, they found ways to increase their earnings. They have a good plan to double what they were from their earnings in 2019 up to in 2023 or 2024. They want to double their earnings during that 5 years period, which is great. And obviously the dividend is increasing all the time. I know you're going to tell me, Mike, the dividend is ridiculous. It's like not even 1% yield. I totally agree with you, but when you look at the capital gain potential over the next 10-15 years, I think that you should look a little bit deeper into AlimentationCouche-Tard. Especially because when you look at its P/E ratio, you're going to rarely find a company that has not done growing. So we're not talking about a mature company. AlimentationCouche-Tard is the second largest convenience stores in the world, and they are in growth mode. Growth by acquisition, with a P/E ratio, the forward P/E ratio under 15. This screams like a buy for me. As I mentioned earlier, this company has a great history of making acquisition, but what I'm fascinated about is the fact that they always tend to say to pay the right price at the right time. So they're gonna let some deals get away. They refused to move on and increase their bid on Caltex last year. They did the same thing with Speedway, and now their latest deal with Carrefour fall off because of the French government. But yet their balance sheet is robust. They are ready to make a large acquisition, and they're just waiting for the right timing to do it. And every time they do one, they integrate their convenience stores perfectly, and they make a lot of money out of it. So I'm confident it will going to happen again. Finally, a lot of investors will tell me, yeah, Mike, that's all great and fun, but what about gasoline sales? I mean, tomorrow we're all going to ride Tesla, so where is the purpose of having a convenience store that is attached to gasoline sales? Well, the thing is, first, it's going to take decades for us to all drive Teslas. If you look at Norway, it's kind of interesting because AlimentationCouche-Tard is present in Norway, and they are really advanced in terms of countries, in terms of concentration of EV, and their electric vehicle fleet is about 14%. So it's not much, not even like 1/4 of all vehicles that are electric. So first, it's going to take a lot of time. Second, this gives them a lot of time to adapt, and this is exactly what they're doing right now by introducing superchargers. Don't forget that one of the major strengths of AlimentationCouche-Tard is their location. They are everywhere, they are convenient to find, they are close to big roads, and obviously if you need to charge your car, a great place to stay in the meantime would be a Couche-Tard. So you go there, you take a moment to charge your car, you go inside, grab a snack, take a coffee, whatever, spend some time in the convenience store where the high margin is, and there you go, you leave the place, and chances are you may even buy more than you used to when you were just fueling the car very in a hurry, just ready to hit the road again. The next one I'm talking about is a smaller company, so be careful with small cap. This full disclaimer here for all the stocks that are being discussed here today. Please do your own due diligence. Do not take that as buy or sell recommendation, especially when you look at a company like PFB Corporation. They are actually making insulated stuff, but they are the first and the only vertically integrated company in this field. What you look here at is the dividend triangle, which is quite awesome actually, because revenues is growing, earning is growing, and you don't see it because they now started to pay a special dividend on top of increasing their dividend, but their small dividend is increasing along the way. There's a bit of a risk here because you can see on the graph there's a huge price jump. The stock doubled in value over the past 12 months, but still they're in the construction business. The construction business is booming, and we need more insulation. We need more building that are cost efficiency, energy efficient, and this all goes with more insulation. When you look at its valuation, well then, a P ratio under 10, trending under the regular value, and especially at a point where the business is about to boom for a few years, this looks very good. The company is principally based in Canada, but they're still active in the US, so they have several plants and manufacturers over there. And this gives them access to both the construction boom in the US and also in Canada. So this helps them to cover a lot of ground. As I mentioned, they are vertically integrated, which means that they're not dependent on commodity prices. They are going to be able to pick the raw material. If the raw material price increase, well, they're still going to be able to make a cut out of it because they are present at every single step of the process. This is great because they know their business inside out, they know their clients' need, and they are able to fulfill them. Obviously, it's a small player in a big ocean, so you have to be careful with that. Another competitor could crush them at any time. But in the meantime, small and great company, great growth perspective, and it's not happening overnight. It's not because of the COVID, because when you think about it, it's been 5 years, they show consistent growth. Now it's just booming a little bit more. They have some rocket fuel to propel their business, but before that they were still doing great. So I think it could be a good addition in your portfolio as well. Now, moving on to a classic energy stock, TC Energy, great pipeline, has not received much market love lately. However, we can still see that there's an uptrend now coming up. Even though Keystone XL project was declined earlier this year, I still think that there's a lot of room for growth for TC Energy. You can see that the dividend is growing on a very steady basis, which I love. And if you look at their valuation, well, then again, P ratio around 15. This sounds like a very good deal. It's not expensive. It has a very generous yield, a great history of dividend growth. If you go on their website, they're going to tell you that they expect to keep up increasing the dividend in a very generous way, which is also very, very interesting for dividend growers. And finally, when you look at how they have built their business, 75% of their business is around natural gas pipelines. The good thing about natural gas is that it's super cheap, and when the economy is recovering or booming, industrials and commercial client needs a lot of natural gas. They will use it because it helps them to create cheap energy, which becomes a competitive advantage, and TC Energy covers a lot of ground on this part. So you can see on the graph they have pipelines pretty much everywhere from northern Canada to all the way down to Mexico. So great opportunities over there, a lot of investment that is coming forward, and when you see what they're doing, what they're expecting is demand for energy is going to continue increase. They have placed their capex at the right place at the right time. They enjoy cheap debt on top of that. So pretty much everything rolls for TC Energy. Pipeline these days don't have much love from the market. There's still risk involved, and obviously you'll have to look at TC Energy debt level because it keeps increasing like there's no tomorrow. I understand debt is cheap, but that could be a problem. But in the meantime, the yield is very generous and the dividend growth is there. So those are very good points if you want to bump up your average yield in your portfolio. This could be a good place to be. Finally, I wanted to end up this video with TD Bank. And actually, TD Bank is not my favorite bank. I prefer National Bank and Royal Bank. But what struck me is while they're doing well, and you can see revenue earnings, you can see a little dent because of the pandemic, but overall quite stable. Now they're not allowed to increase their dividend, but it's going to come up at one point or another as we see the economy recovering, and as we see that the default for loan is not that important. Probably that regulators will allow the financial industry to increase their dividend later on. Maybe we won't have any dividend increase this year, but what is fascinating right now about TD, it's its valuation. It's part of my top three. Actually, I prefer National Bank and Royal Bank, as I told you. But if I had to buy a third one, it would be TD Bank. But what struck me here is that it trades at its lowest valuation compared to all its peers. So I can understand that you may not be that interested in National Bank and Royal Bank right now because they're trading around 14 and 15. And by the way, for banks, a 15 PE ratio is huge. The thing with Canadian banks is that they're historically trades around 12, 13, 14, but they're always very, very conservative in terms of valuation per earnings. Quite different than other sectors. So when you look at this chart and you have a company, a bank that is doing well, that is well established everywhere, and it's definitely not the laggard in this industry, trades at such a bargain, I would put an asterisk on this one and take a closer look. TD Bank, in summary, and I have a lot of videos about banks because, you know, I used to be a banker, so I love them. But just to let you know, the company is like pretty much halfway between US and Canadian. They have a lots of US retail, but they also have now a great chunk of Charles Schwab. So on this graph you see for the fiscal year of 2020 how the earnings are separated. TD Ameritrade was bought by Charles Schwab, and in the process now they got a good chunk. I think it's like 13 or 15% of Charles. So they still are very active in the investment side in the US, and overall the company keeps things, everything is quite simple. It's a classic bank around savings and loans, but they do have the wholesale and TD Ameritrade focus towards investment. So definitely a great player in the banking industry. They can generate a lot of money from their position of strength in Canada, and they have that growth that is coming from the US. I still prefer the other two, as I mentioned, but considering the valuation right now, it would be foolish to not put it on your list and look a little bit deeper. So I hope that you enjoyed this top 5. If you have any question, go in the comment section. Sorry, I can't speak anymore. Also, I'll be curious to know what is your favorite undervalued stocks in the Canadian market right now. Did any stock that I missed maybe? That will be interesting to discuss those as well, and maybe make a video about them at a later point. And until the next video, stay invested.